Hey, Tyler Crow.
Yeah,
Guess what? It's official.
it finally happened where it's like the end of a rom-com.
ExxonMobil is officially buying Pioneer Natural Resources. We saw the press release come out from Exxon this morning before the market opened. I'm Jason Hall. This is The Smattering. Tyler and I are going to talk about this deal for Exxon to buy this giant in the Permian, whether or not it's a great deal for investors, and how they should think about ExxonMobil stock going forward. Just a reminder that our videos are sponsored by The Motley Fool. If you're looking for even more great stock ideas, please go to our special link, fool.com/the smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Please be sure to check out that link after this video. Tyler, we got to go back to this spring. You and I, the rumors first came out that ExxonMobil was on the hunt. And Pioneer was one of the companies that was rumored going back to March or April. Is that right?
Yeah, I think it was the primary target for ExxonMobil for numerous reasons. Number one, it's actually big enough in terms of size to actually move the needle for
Yeah.
ExxonMobil. And we'll get into the details specifically of why it's happening, why ExxonMobil picked this one specifically, at least why management is saying it. It's been like this on again, off again. I think there's been a lot of talk about M&A recently. Companies are flush with cash, and so it seems like a good time to consolidate. And I don't know, ExxonMobil's CEO just stood outside of Permian's office, holding the stereo over their head,
Going back to our
doing the
rom-com.
doing the
Yeah,
Lloyd
say anything.
Dobler.
There you go. You
So
got the boombox out. And you know what? She came to the window.
that's right.
So here we are. All right. So here's the nuts and bolts of the deal, roughly $60 billion deal. Again, this is going to be based on stock prices because this is an all stock transaction, right? It's all stock. I don't think there's any cash
Yep,
in the deal.
all stock.
Pioneer investors are going to now become ExxonMobil investors when the deal closes. So that's the nuts and bolts of that. That's important. We're going to talk about why it's important in a few minutes. But first of all, what is Pioneer Natural Resources, Tyler, and why would ExxonMobil be buying it?
Pioneer basically owns a boatload of acreage in Texas, and that's all that ExxonMobil really cares about,
Yep.
specifically in the Midland Basin of Texas, which is part of the big Permian Basin there. It's the biggest oil patch in the United States, and shale has been a transformative event for the Permian Basin. It was huge in the 1910s. So 110 years ago, and now it's popular again thanks to shale. And the reason specifically that Exxon wants to go here, like I said, it's big enough to move the needle. Combined with ExxonMobil's Permian production and Pioneer's production, it'll be about 1.3 million barrels per day just out of Texas alone for ExxonMobil, which before this deal was 4 million barrels per day, more or less. So this is a big deal. This is a lot of oil for even ExxonMobil.
So the oil coming out of that area is plentiful, relatively low cost to produce, which is, again, important in this environment. Oil prices are high, but these companies have learned the lesson with shale. When your low cost producers in the world continue to be Saudi Arabia and some of the other OPEC producers, you have to have price flexibility and be able to keep your cash cost of production very low as prices fluctuate. And there's also some benefits of adjacency, right? Because ExxonMobil does already have a pretty substantial presence in that area. So the adjacency of it to where they're already producing, there should be cost benefits as well, right?
Yeah, and I've heard the argument made recently that independent oil producers in the United States aren't nearly as useful as they were a few years ago. Back in 2012, 2013, when they were all experimenting with shale, when the big players wouldn't, they had some value. But now it's become almost like this manufacturing thing. They know where all the oil is. It's not like we're going and finding new shale oil.
They've been known about
Yep,
since the 50s, really, the 40s and
yep,
50s. What the independents have done to figure out how to get it out of the ground in a cost
yep,
effective way. That's
exactly.
what's changed.
But now that it's just cost, it's trying to wring out every cost possible. It's your overhead, it's your administration, it's your energy trading firms built into it. Everything that you're trying to do is basically lower like every dollar possible to make the best margin. And so going in-house with the integrateds makes sense, right? Exxon estimates that with this deal, they get a lot of overlapping acreage, which means when you want to drill really long wells, really long laterals, you can go over longer acreage because you have continuous acreage now that you don't have to pay royalties to somebody else.
Are you telling me that the synergies that get highlighted with big deals, and a lot of times this is a case where they actually really exist in their material?
They could exist. It's if management can do what it says it does. But based on that, all of these things theoretically make sense, right? It can really wring out costs. It can improve its growth profile for the next couple of years because it gives it a good growth pipeline in terms of total cheap reserves. And also flexible spending, because as we've seen with shale, kind of turn it off, turn it on when you need to, versus those mega projects like the deep offshore wells or LNG export facilities that take decades to build and billions of dollars. You get a little bit more flexibility, you get relatively low cost. And so, as an Exxon shareholder, I hope that is exactly how it works.
I think this is the part where we should make the cautionary tale argument, because this is a company you've owned for a long time. You and I both covered it for well over a decade. And we can go back
Mm-hmm.
the last time Exxon made a substantially large acquisition like this, and it was a company called XTO Energy.
That's right. Everything that we just used to describe the Pioneer acquisition is what they did to describe the XTO acquisition. XTO was going to be this transformative shale purchase in
At the
2011,
time, XTO
2012.
Energy was the largest natural gas producer in the United States. It was a giant.
Yep. Huge natural gas reserves all over the country. Was one of the pioneers in terms of shale drilling in the United States, but specifically for natural gas versus oil, because at the time, in 2011, 2012, even to 2010, like shale drilling was for gas. It wasn't for oil. We hadn't quite cracked the code in terms of drilling for oil with shale. And so that idea at the time, ExxonMobil's kind of in a weird, similar position, kind of a little bit stagnant growth, had lots of cash, didn't necessarily know what to do with it. What are we going to do with all this extra cash? And they decided to buy XTO, thinking they, as the best operator, you can wring out the costs, you can do all this, which all of it in theory made sense. The only problem was is that, number one, they paid an awful lot of money. This was basically like buying a shale company at the peak of shale pricing.
Right.
And
The
so,
dollar value of the deal was less than this one. And if you adjust it for inflation, probably similar price.
yeah,
But again, the timing, I think, is an important thing to highlight. Like you said, shale production costs very, very high. And gas prices were actually really high too.
yeah,
And then over the next decade, gas prices would fall precipitously.
yeah. It was, shale was a major success, so much of a success that we had too much of it, and basically changed the game of how gas is priced in the United States. It's been a transformative thing that is for another video. But again, I just want to emphasize this. There's just kind of this thing in the back of my head that says, beware XTO, just a little bit, because I see this deal, it's all stock, so it's not like it's taking on a bunch of debt to do this. It's not adding leverage to an already pretty good balance sheet. So it's actually going to look even better at the end. But at the same time, that's a lot of capital. You're still deploying capital by issuing equity, and you have to spend it the same way that you would be making a capital investment in something organically. Are we 100% sure that the price that ExxonMobil paid is going to be value accretive? And I don't know. And that's the one thing that gives me pause. It's something that is going to be in the back of my mind when I watch their quarterly earnings for the next several quarters.
I'm going to make the case, Tyler, the bull case here. Why I think it's a pretty good deal, why I think it makes sense, and why I think it's going to be good for shareholders. So I'm going to start with the pricing. I think that's important. Again, it's an all-stock deal. And you said it yourself on a recent video that we did that ExxonMobil stock's expensive right now. It's not crazy
It's not the
expensive.
cheapest one of the group.
No, it's not. It's not. It's on the expensive side. And none less than Warren Buffett have talked about, and there's a book called The Outsiders that I encourage investors to read about successful CEOs and capital allocation. A lot of it is, when do you buy stock? When do you sell stock? And when you're buying another company with your stock and you're using that as capital, you want to do it when your stock is expensive. So that's smart. Now, the counter argument is, if you look at Pioneer Natural Resources stock, it's also pricey, but about 6.1 times operating cash flow for Pioneer. ExxonMobil stock trades for 6.5, 6.6 times. Again, that's today. The numbers are going to move around. But to me, it looks like a pretty reasonable price to pay. The next thing, let's talk about XTO versus Pioneer. We talked about it already, how the industry has fundamentally changed from where it was a dozen years ago. This is a mature industry. Shale, these producers know how to make money. And at the time, XTO became one of the largest by absolutely incinerating money to develop its assets, to acquire the assets, and was living off of high gas prices, and it still had high production price costs. So that dynamic is very different with what ExxonMobil is buying right now. Pioneer's cash production costs are very, very low, right? Right. That's a really positive considering that oil's in the 90s now. So it's buying really cash generative assets. And that's a huge difference between what it was acquiring when it bought XTO. The other thing that I want to point out, Tyler, is that if you look at the ExxonMobil that bought XTO versus the ExxonMobil that just bought Pioneer, agreed to buy Pioneer, the management team, their capital allocation process, this is a company that over the past, really since 3 or 4 years after buying XTO Energy, has spent 6 or 7 years, as you called it, sweating assets and sweating costs, wringing out all of the waste and excess in their business. And this to me feels like a more disciplined, focused bolt on. It's a big bolt on. I'm not kidding. I'm not going to get around that. It's a big bolt on, but
But
it's still a bolt on.
anything's a bolt on for ExxonMobil.
It is, right? It's not, this is not a transformative in the way that an oil focused ExxonMobil was when it acquired a gas focused XTO. This is a company paying a reasonable price to buy some really low cost oil assets that are adjacent to their existing oil assets. And I think it's going to be really cash generative for the business over the long term. I think at the least it's going to be neutral for shareholders, if not positive.